Welcome to another audit walkthrough video from SuperfastCPA. I'm Logan, and in today's video, we're going to be going over Audit Area 2. This is Section E. This is an application topic. Determine risk of material misstatement, whether due to fraud or error, at the financial statement level and relevant assertion level for each significant class of transactions, significant account, and disclosure. And we're going to be doing that the SuperfastCPA way, which is diving straight into the questions to learn the material. Now, if you don't know much about our strategy, make sure you go to SuperfastCPA.com and sign up for our free 1-hour webinar training. We will teach you the key ingredients to passing the CPA exam. And again, it's free, it's 1 hour, it's something you don't want to miss. So make sure you go check that out. And after you watch that, you're going to want to learn more. Something you should know is in this video, we're only going to be going over 5 questions, but SuperfastCPA Pro members will get access to the full 10-question video when we post it in the member forum. So if you like this and you like our other products, make sure you check out becoming a SuperfastCPA Pro member because you'll get access to the full 10-question versions of these videos, as well as access to the Pro course, which is where Nate explains in detail exactly what you're supposed to be doing every single day to pass these exams. Now, with all that out of the way, let's dive straight into the questions. Okay, here we are at question 1. When assessing the risk of material misstatement, what is the auditor's primary responsibility? Okay, let's dive into the options. Option A, to provide absolute assurance that the financial statements are free from material misstatement, whether due to fraud or error. Option B, to provide reasonable assurance that the financial statements are free from material misstatement, while recognizing that some risk of undetected misstatement remains. Option C, to eliminate the risk of material misstatement by performing detailed substantive testing on every transaction and balance. Or option D, to ensure that management's internal controls completely prevent material misstatements from occurring. Now, if you don't really know what risk of material misstatement is, that's okay. That's the point of doing these questions, is to learn what we're supposed to know for test day. So let's dive straight into the explanation for this one. All right, here we are at the answer B, to provide reasonable assurance that the financial statements are free from material misstatement while recognizing that some risk of undetected misstatement remains. Now, we've talked about this in previous videos. You can't make sure that you catch every single error, but you give reasonable assurance. So let's talk about this. An auditor's responsibility is to provide reasonable assurance that the financial statements are free from material misstatement, whether due to fraud or error. Reasonable assurance means that the auditor has obtained sufficient audit evidence to reduce audit risk to an acceptably low level, but not to zero. Because of inherent limitations in an audit, and we've talked about that in a previous video, there is always some risk that material misstatements remain undetected. So that's something that you've got to always remember as you're talking about control risk and things like that. Now let's talk about the other answers and why they were incorrect. Option A was incorrect because absolute assurance is not possible because audits involve sampling and professional judgment, and some misstatements may go undetected. Option C was incorrect because the auditor does not test every transaction, but instead uses risk-based procedures to focus on areas most susceptible to misstatement. And then option D was incorrect because while auditors evaluate internal controls, management, not the auditor, is responsible for designing and maintaining them. The auditor assesses whether controls reduce the risk of material misstatement, but does not ensure they eliminate all risk. Now, we learned a little bit about the auditor's responsibility when it comes to risk of material misstatement. Now let's go to the next question. All right, here we are at question 2, and something I always like to point out when it's an option is to read the last part of the question first. Now, in this case, it might not be extremely helpful because there's only 2 sentences and they're pretty short. But again, this is a good habit to be in because imagine you see a paragraph or 2 paragraphs of a question and you don't really know what you're looking for as you're reading through all of it, and then you finally get to the end and realize, oh, I was supposed to be looking at risk assessment or the role of risk assessment. Whereas if you read the last part of the question first, it will give you context a lot of the time for what the question is about so that you know what to be looking for throughout the question as you're reading it. So let's do that here. Which of the following best describes the role of risk assessment in the audit? Okay, let's go up to the top. During an audit, the engagement team holds a fraud brainstorming session as part of assessing the risk of material misstatement. So again, which of the following best describes the role of risk assessment in the audit? Let's go through the options. Option A, the fraud brainstorming session is the primary step in assessing risk. And once completed, the auditor's assessment of the risk of material misstatement remains unchanged throughout the audit. Option B, the fraud brainstorming session is required only when the auditor believes that there is a high risk of fraud, and the auditor's risk assessment is only performed at the beginning of the audit. Option C, assessing the risk of material misstatement is an ongoing process that begins during planning, including the fraud brainstorming session, but may be revised as new information is obtained during the audit. And then finally, option D, once the risk of material misstatement is assessed during the planning, the auditor's procedures are fixed, and any new risks identified later should be disregarded unless they relate specifically to fraud. Now, I think it's probably pretty obvious which one of these is correct, just based off of deducing, kind of reading through them. If you don't know the answer, that's okay. Go ahead and pause the video if you want to, think through this, and when you're ready, come back, we'll look at the answer together. All right, here we are at the answer C. Assessing the risk of material misstatement is an ongoing process that begins during planning, including the fraud brainstorming session, but may be revised as new information is obtained during the audit. So, that's the correct answer. Let's walk through the explanation. The assessment of the risk of material misstatement, or RMM, is a continuous process throughout the audit. It begins during the planning phase, where the engagement team holds a fraud brainstorming session to discuss how financial statements might be materially misstated due to fraud. However, this initial risk assessment is not static. As auditors gather evidence, perform procedures, and identify new risk factors, they must update and refine their risk assessment to ensure the audit remains responsive to emerging risks. Now let's talk about why the other answers are incorrect. Option A, risk assessment is not a one-time activity. And we basically just said that. The fraud brainstorming session is an important part of planning, but the auditor must continually reassess risk throughout the audit. So the fraud brainstorming session is required, but it's not the only thing that you're doing to assess risk of material misstatement. Option B was incorrect because the fraud brainstorming session is required, like I just said, regardless of whether fraud risks seem high. Additionally, risk assessment is not limited to the planning phase. And again, that we're just kind of repeating ourselves. And then option D, the auditor must remain flexible and adjust procedures if new risks emerge. Ignoring new risks could lead to undetected material misstatements. And that's pretty clear, that's pretty obvious. You wouldn't want to ignore the things that come up to say, hey, there actually is probably a risk of fraud here. So I think that makes sense. Now let's go to the next question. All right, here we are at question 3. Which of the following situations would most likely cause the auditor to increase their fraud risk assessment? Let's go up to the top. During an audit, an auditor is assessing the risk of material misstatement due to fraud. And again, which of the following situations would most likely cause the auditor to increase their fraud risk assessment? Let's go through the options. Option A, the company's accounting department has recently experienced high turnover and several key roles are now filled by less experienced employees. Option B, the company has significant cash transactions and relies heavily on manual record keeping for certain revenue streams. Option C, management has a history of optimistic earnings forecasts, and a significant portion of executive bonuses is tied to meeting aggressive financial targets. And then option D, the company operates in an industry with volatile market conditions, leading to frequent adjustments in financial projections and estimates. Now, if you want to, pause the video, think through this. If not, that's okay. We're going to look at the explanation together to understand this. But again, I think you should pause the video to kind of think through this and read through the different options. And when you're ready, come back. We'll look at the answer together. All right, here we are at the answer C. Management has a history of optimistic earnings forecasts, and a significant portion of executive bonuses is tied to meeting aggressive financial targets. So that is something that the auditor definitely is going to notice and is going to say, that's going to increase fraud risk. That's going to increase the risk of material misstatement because of fraud. So let's read through the explanation. Fraud risk increases when management has strong incentives to manipulate financial results, particularly when compensation is tied to earnings or financial targets. A history of optimistic earnings forecasts may indicate a tendency to aggressively recognize revenue or delay expense recognition, increasing the risk of fraudulent financial reporting. And we talked a lot about fraudulent financial reporting in the previous video. And again, this all has to do with risk of material misstatement. You are trying to make sure that there's not material misstatements due to fraud or maybe due to error, and we're going to talk about that in a second. But let's talk about the other options and why they are incorrect or why they're less likely to be indicative of fraud. So option A, high turnover and inexperienced staff can lead to errors or control weaknesses, which may increase the risk of unintentional misstatements. However, this alone does not necessarily indicate fraud risk unless combined with other factors such as management override or intentional misstatements. Option B was incorrect because heavy reliance on cash transactions and manual record keeping creates an opportunity for fraud, particularly for asset misappropriation. However, this is more of a control risk rather than a direct fraud indicator related to financial reporting. And then option D, volatile market conditions and frequent financial estimate adjustments can lead to increased judgment in financial reporting. But this does not automatically imply fraudulent intent. It may, however, create conditions where management is more tempted to manipulate results. So we talked a little bit about fraud risk when it comes to risk of material misstatement. Now let's go to the next question. All right, here we are at question 4. Which of the following situations would most likely increase the auditor's assessment of this risk? Let's go up to the top. An auditor is assessing the risk of material misstatement due to error. So again, which of the following situations would most likely increase the auditor's assessment of this risk? Now let's read through the options. Option A, the company's CFO exerts significant influence over the accounting department and has overridden internal controls in prior periods. Option B, the company has recently implemented a complex new revenue recognition policy and accounting personnel are still learning how to apply it correctly. Option C, the company has experienced declining financial performance and management has strong incentives to meet earnings targets. Or option D, a significant portion of executive compensation is based on achieving specific financial results, leading to potential pressure to manipulate earnings. So again, which one of these is going to more likely lead the auditor to assess the risk of material misstatement higher due to error? Now pause the video, think through this. We're talking about error instead of fraud here, so think about that. And when you're ready, come back. We'll look at the answer together. All right, here we are. The answer is B. The company has recently implemented a complex new revenue recognition policy and accounting personnel are still learning how to apply it correctly. So this would be something that would more likely lead to risk of material misstatement when it comes to error instead of fraud. So let's read through this. Errors are often caused by complex accounting policies, lack of experience, or inadequate training. A new revenue recognition policy introduces a high risk of unintentional misstatements, especially if employees misapply the standard, miscalculate revenue timing, or fail to properly record transactions. So risk of material misstatement isn't only going to come from fraud, it can definitely come from errors. So auditors need to not only be looking for things that could indicate fraud or make fraud more likely, but also need to be looking for things that would more likely cause errors in the company and how they run their accounting and everything like that. Because fraud is on purpose, error is by mistake. Let's walk through the other options and why they're incorrect. Option A, management overriding controls is a strong fraud risk factor, as it suggests intentional manipulation rather than unintentional errors. Option C, when a company faces financial pressures, there is a greater risk of fraudulent financial reporting rather than errors. Errors typically stem from mistakes, not pressure to manipulate earnings. Again, there's that difference there. And then option D, executive compensation tied to financial results is, again, a fraud risk indicator. And we talked about that in the previous video, as it creates incentives for intentional misstatements, whereas errors arise from misunderstanding or misapplication of accounting principles. Now with that, let's go to the next question. All right, here we are at question 5. Which financial statement assertion is most at risk of material misstatement? Let's go up to the top. During an audit of ABC Corp, the auditor identifies the following issue. The company's sales team has been recording revenue as soon as contracts are signed, even though the company's policies and GAAP require revenue to be recognized only when goods are delivered or services are performed. As a result, several large transactions recorded in the current year actually relate to services that will be provided next year. So again, which financial statement assertion is most at risk of material misstatement in this situation? Now, we've talked about the financial statement assertions kind of throughout multiple videos. If you understand what those are, then you'll be able to understand this. But even if you don't fully remember what the financial statement assertions are, read through these different options, and I'll read through them with you, and just kind of think of what the words mean. And I think that you'll probably be able to pick out what is happening here. So let's go through the options. Option A was occurrence. Option B was completeness. Option C was cutoff. And option D is valuation. So again, which one of those financial statement assertions is at risk of material misstatement because of this situation? Now, pause the video, think through this, think through what those words mean, and when you're ready, come back, we'll look at the answer together. All right, here we are. The answer is C, cutoff. So let's walk through the explanation. The cutoff assertion ensures that transactions are recorded in the correct period. In this case, revenue was recorded too early, meaning some revenue in the current year is actually related to the next period. This misstatement affects the timing of revenue recognition, making cutoff the most relevant assertion at risk. Let's talk about how this relates to financial statement risk, as a whole. The financial statement level risk here comes from weak controls over revenue recognition, which could impact multiple areas of the financial statements, not just revenue. If revenue is overstated, then net income, retained earnings, and accounts receivable may also be misstated. This broad risk means the auditor may need to adjust the overall audit approach, such as increasing substantive testing or reviewing revenue controls more closely. So again, when there's something that is a risk to a specific assertion, a lot of times it can affect the financial statements as a whole as well, depending on how it's affecting things. Now let's walk through why the other assertions weren't quite correct in this situation. Option A was occurrence. Occurrence ensures that recorded transactions actually happened. Here, the revenue transactions are real, but were recorded in the wrong period. Option B was completeness. Completeness ensures that all revenue that should be recorded is recorded. The issue here is early recognition, not missing revenue. And then option D was valuation. Valuation would be at risk if revenue amounts were incorrect. And so that would be things like miscalculated pricing or uncollectible revenue. But this scenario is about timing, not valuation. So again, the financial statement assertions have to do with the risk of material misstatement. They can be at risk because of different things that are happening. And with that question, we learned a little bit more about financial statement level risk and assertion level risk. And basically, just to make sure that that makes sense, financial statement level risk is about kind of things that are going to affect the financial statements as a whole or affect it in multiple ways, whereas an assertion level risk might just affect one assertion, like, again, the timing of revenue or things like that. Now, with that, we've learned a lot in just 5 questions. Before we do anything else, let's do one more part of the SuperfastCPA process called pillar topics. Now, the idea behind pillar topics is as you're going through the questions to learn the material, you will notice the things that keep popping up. You've seen 2 or 3 or 4 questions trying to teach you about the financial statement assertions, or you've seen 2 or 3 or 4 questions trying to teach you about the different factors that might lead to risk of material misstatement when it comes to fraud or when it comes to errors or whatever the case is. You notice these things throughout the questions, and so you take a moment and you write these out in your own words as pillar topics. Again, these are the most important things you learned. And as you're doing this, each day you're building your own personal repository of the most important things you learned from the questions, and you wrote them down in your own words so that you're ready for test day. Now let's go ahead and look at the pillar topics for this video. Okay, here we are at the pillar topics. Let's just dive straight in. First, let's talk about reasonable versus absolute assurance. This is something you need to make sure you understand about risk of material misstatement and just risk in general. Auditors provide reasonable assurance, not absolute, because they use sampling and professional judgment and cannot eliminate risk of all undetected misstatements. Let's talk about continuous risk assessment. Risk assessment begins in planning, and that includes the fraud brainstorming session, but must be updated as new information emerges throughout the audit. Let's talk about fraud risk indicators. Management incentives, prior control overrides, and aggressive earnings targets are strong signals that can increase the auditor's fraud risk assessment. And then let's talk about error risk indicators. Complex or newly implemented accounting standards, inexperienced personnel, and frequent restatements often point to higher risk of unintentional misstatements. And again, this all has to do with risk of material misstatement. These are the things that you want to be looking for. Finally, let's talk about financial statement level versus assertion level risk. Financial statement level risks affect the entire financial statements, like overarching control weaknesses, while assertion level risks focus on specific accounts or disclosures, such as cutoff for revenue or ownership of inventory. Both must be evaluated to ensure the audit addresses all areas where material misstatements could occur. Now with that, we've gone over the pillar topics, and that is the end of this YouTube version of the video. Remember, we only went over 5 questions, but if you become a Superfast CPA Pro member, you'll get access to the full 10-question version of this video and the other videos that we make. So if you like this, make sure you check out becoming a Superfast CPA Pro member. And the easiest way to do that is actually to go to SuperfastCPA.com and sign up for our free 1-hour webinar training. We teach in that 1 hour the key ingredients to passing the CPA exam, and after you watch that, that will give you a clear path to becoming a Superfast CPA Pro member. So make sure you check out the webinar, check out becoming a pro member. Now again, if you liked the video, make sure to like it and leave a comment. I hope this video was helpful, and I will see you in the next video.